In today's world, debt is very easy to get into, but very difficult to get out of. Why do I say this? Debt has existed all throughout the world's history. But right now, debt is more accessible than ever. Personal loans, credit cards, then buy now pay later schemes by all major retailers. These are so widely available and accepted that you get into it without any thought of having to repay it back. Many people also get into debt because their expenses are much more than their income. And what do they end up with? They end up with, say, a home loan or a personal loan at first, and they end up having more and more loans and unable to repay any of it. So in this video, we'll discuss what to do if you're in debt, how to get out of it as fast as possible, and how to avoid the debt trap in the first place. This is the second video in MarketFeed's Personal Finance 101 series with me, Ajay Ajit. Welcome to the video. The first thing that you should do if you're in debt is to understand your exact situation. Just like in the last video where we discussed about everything related to budgeting, you should create a spreadsheet or an Excel sheet of your own where you list down every single debt that you have along with the interest rates and the EMIs due for that. And sometimes debt is okay because if you're able to pay whatever you have currently within your current budget, debt is an okay thing to have. But let's get more into the intricacies of it. There are two types of debts in this world. There are good debts and there are bad debts. We can also call it good loans and bad loans for the sake of it. What are good loans? Good loans are something that has a potential to increase your wealth over time. And bad loans are something that will make you end up paying high amounts of interest over the long term for a depreciating asset. And if you're someone with a keen eye, you can already make out the differences or the examples of differences between a good debt and a bad debt. Buying a laptop to get your freelancing work, get better work done, it's a good debt. Taking a loan out to make sure you get a higher education and that you're succeeding in life, it can also be a good debt. And maybe taking a loan to expand your business, current business, and take it to higher places, it can also be a good debt. Sometimes even buying a car in debt, which can ease your travel and help you reach your business goals, can also be a good debt. But buying an iPhone just when you get your first paycheck, buying a car just to impress your friends or your family or your co-workers, these are all examples of bad debt. So since this is a Personal Finance 101 series, let's start with what to do if you're in debt. The first thing that I would suggest, especially if you have loans that are tied down to certain collaterals, is that get a life and personal insurance. Suppose you build your dream house, it costs you 1 crore rupees and you're living in that house with your family, you're having a wonderful life, you have the enough income to support this lifestyle. But one day you're the major bread earner of the family and an unfortunate situation comes into your family where you as the primary breadwinner, you pass away. What would happen to that family home that you built? I know it's a very unfortunate instance, but in cases like this, a life insurance policy can take care of your family's expenses, including this home loan, for a considerable amount of time. And in another case, let's say a health emergency affects you or your family members, wherein you have to take a lot of money out of your savings and then use that to pay your medical bills. You might have been paying your debt, your loans all perfectly till that time, but once that situation kicks in, you might not be able to pay up because you have to pay a huge amount to the hospital for the medical emergency. In that case also, insurance plays a huge role. So the first thing that I would suggest to anyone trying to get out of debt in a very systematic manner is to take out insurances under your name and your close family relatives' name. And now that the difficult part is done, let's get to the crux of the video. Say you're someone with a home loan of 50 lakh rupees and you're owing your friend or your uncle 1 lakh rupees. What do you have to do here? Your uncle or your friend is a very understanding person and they might not ask you for this debt back very easily or very quickly. So it's an okay case. But what if that family member is causing a lot of emotional distress to you? It is causing a situation where you cannot run your business, where you cannot do your job properly. In that case, you might be better off holding off this home loan payment and paying off your uncle instead. Does it make sense? If that makes sense to you, this is what is called institutional versus psychological way of paying off your debt. because you have to, in the future, you'll anyway have to clear all of your debts. That's the goal. That's why you're here. And in that case also, if something psychological is affecting you, someone is harassing you maybe, and that is causing you issues with your day-to-day life, you might be better off paying off that loan first. Now that is a very psychological and personal way of paying off your loans. So now let's get into the structured way of paying back your loans. In this method called as the Debt Avalanche Method, what you have to do is you have to write down all your loans in a decreasing order of their interest rates. That means the highest interest rate loan on the top and going ahead with lower and lower interest rate loans on the bottom. And what you have to do here is that these certain loans, if they're institutional loans, they might have a minimum EMI amount payable, right? You might have seen it when you've taken a credit card. You might have seen that your credit card bill due for this month is 25,000 rupees, but then you have a minimum amount due of 8,000 rupees as well. So in this method, what it says is that you have to pay off every single loan at their minimum amount due. This will make sure that your credit scores are not affected and you will not be a defaulter in the bank's eyes. And when you pay all the minimum amounts due in all of these loans, ideally you should be having a excess amount with you, right? Because you've paid only the minimum amount. And once you have that excess amount, you should go ahead and pay off the highest interest rate loan first. So now that you understand the debt avalanche method, this is perfectly paired with the banking industry secret, which says that if you have some trouble going ahead and paying your EMI, say your home loan EMI is for 50,000 rupees every single month, and you have a difficulty paying that amount and you do not have a minimum amount due option like a credit card. This secret in the industry is that you can go talk to your bank and you can restructure your loan. So in this situation also, you're not going to be a defaulter under the bank's eyes. You're just asking for a different EMI structure. In the longer term, the bank will end up making more and more interest from you. But in the shorter term, your cash flow problems might be reduced and you might be able to pay off your larger loans quicker. Now, under all these conditions, your credit score should ideally remain the same or constant in a way that you're paying off your credit dues at the end of the month and you're not considered a defaulter. According to a lot of industry experts, this is the best and the most economical way of paying back your multiple loans. So now that we've learned this method of paying back all your debts, what we should look into next is how to avoid this debt trap in the first place. One is to build an emergency fund or a rainy day fund. In the first video in this series, we had discussed about how to set a budget for your life. And once you're doing that, you'll have a fair bit of understanding where your money is being spent every single month. The emergency fund that you keep aside is to be designed in such a way that it is highly liquid. It is available to you in such a time of hardship where you have to immediately access that money, and it will be growing with some percentage of interest as well. Now, the thumb rule for having an effective emergency fund is that you should have enough money in a separate high interest rate savings account in a separate bank account, which is enough to cover 6 months of your current living expenses. And this should be done regardless of who you are, what your profession is, what your family background is. This should be done regardless of all of that. Now, what this rule says that, again, if you're someone with an expense of monthly 30,000 rupees, this rule says that you should have a separate bank account with a corpus amount of 1.8 lakh rupees, 6 times of your monthly expenses in that separate bank account. Again, this might not be easy to build. It might take you multiple months or even multiple years to build it out. I would suggest you that this is the first thing that you should be doing in your personal finance journey. Is this the best method of keeping away your emergency fund? I would agree not, but this is the thumb rule for doing it. This is one rule I can suggest everyone who is watching this video that you can follow. We'll be having a detailed video on everything that you should be knowing about maintaining a long-term emergency fund on this channel itself, so make sure you're subscribed for the same. Along with building an emergency fund, you'll also have to take a health insurance. Suppose, listen to this example. You're someone who's working really hard in your life. You've made a lot of money. You say you've kept aside 5-10 lakhs in your investment journey and you're doing really well in life and you're very happy. Right? And in such a situation, you do not have any loans, you do not have any debts of any kind, you're living a happy, peaceful life with you and your family. And in such a case, let's say in an unfortunate situation, again like the first unfortunate example, a situation, a family emergency happened where you had to pay an amount of 10 lakh rupees to the hospital. Your current savings of say 5 lakh rupees, that is all washed out and suddenly you're in a debt of 5 lakh rupees. So what do you have to do? The first most important thing in any individual's life, get a health insurance policy for you and your loved ones. Now, even with the small amount that you'll be paying out for the insurance company every single month, you'll be having a lot of peace of mind, as well as your financial journey will also be secure. Just note that the insurance policy that you take out under your family's name, it has a cashless option, wherein if you go to a hospital, you can use the cashless option so that the insurance company pays the hospital directly. And also note that the major hospitals near your home or the place that you reside in are covered under this policy. So you build an emergency fund and you've taken a health insurance under your name as well as your loved one's name as well. And you're doing well in life, and you start getting these calls from credit card companies asking, hey sir, do you want to take this credit card? It's having really good offers. Do you want to take it up? So credit cards are a really useful and effective tool if you're someone who's exceptionally well at managing money. Now, the risk that you're putting yourself in while taking a new credit card is that, say you're going to SBI cards for a new credit card. The general thing that they'll do is they'll give you at least 3 times of your monthly income as your credit limit. Now, this is without question. It's a non-collateral loan that you're getting from these credit card companies, and they're directly giving you 3 months worth of credit limit for that credit card. So the assumption here is that you'll go on a shopping spree, you might go up exceeding your monthly income as well, and you'll be ending up paying a lot of interest to these credit card companies. So make sure that you follow the thumb rule, which says that use only up to 30% of your credit card limit. Now it makes sense, right? Suppose you're someone with a salary of 50,000 rupees. These credit card companies will at least give you a credit limit of 1.5 lakh rupees to spend. 30% of that is the maximum that you should be using, which is your monthly salary which you're receiving. Also, what I'm seeing as a very saddening trend all throughout India is a rise of unregistered Chinese or even Indian loan app scams. Now, these loan apps, what they'll give you is that for minimum documentation, they'll give you huge amounts of loans for very high interest rates. It can even go up to 35% per annum. Now, what they'll do is, if you fail to pay back these loans, they'll start harassing you, they'll start harassing your contact list, and they'll end up making your whole life a huge mess. So make sure you avoid these apps at any cost. And if you're in urgent need of a loan, go ahead and contact your bank, and they'll be able to help you with a personal loan or anything of that sort if it is such a big emergency to you. And the next point, funnily, is that I would say, do not buy an iPhone with your first paycheck, especially someone who's living on a 20,000 rupee salary. I can't even count the number of friends which I have who have bought iPhones with their very first salary of 20,000 rupees, because nowadays you can easily get an EMI for that. So what is the problem, right? You can get an EMI, you can pay it back even with your small salary. But what I would suggest you very strongly is that if you're paying for something that is in your wants list, that means something that you do not really need, but that you want, that might give you happiness. Make sure you have at least that amount separate in a bank account with you. So let's say you want to buy an iPhone 13 for 50,000 rupees. You can go ahead and buy it on an EMI even, if you have that 50,000 rupees amount with you available as cash in a separate bank account. Okay, so with that iPhone example, I'm hoping that you got a lot of value from this video. So this is Ajay signing off. See you in another video. Make sure you're subscribed. Bye bye.